Hi class, welcome to chapter 9, long-term liabilities. We're still moving down the balance sheet. We only have a few chapters left. Hang in there, you're almost there. You did great on the exam. I just want to run through some examples for chapter 9. I have 4 examples. Hopefully this will help. So the first one is exercise 9-2 from your textbook. And this is about recording installment notes. So this company on January 1st, and of course most companies don't purchase things on January 1st, but this just makes it a little easier to understand. They borrow $50,000 by agreeing to a 6% 6-year note with the bank. They're going to use this cash to purchase a new BMW convertible. There's a distinction there. They didn't borrow the money directly for the vehicle. They got the cash and then purchased the vehicle. So loan payments are $828.64 and they're due at the end of each month, with the first installment due on January 31st, 2021. And this is typical of an installment note. You don't want your payments to change. Your payments are always going to be the same. What's going to change is the amount of interest and principal in each payment. And you'll see what I mean as we do these. So on 1/1/21, they borrowed from the bank. They got cash of $50,000 and they signed a notes payable for $50,000. So we're going to go ahead and post the $50,000 to the notes payable account. And then we want to make the first 2 monthly payments, the journal entry for the first 2 monthly payments. They're due at the end of the month, so the first one is due 1/31/2021. And we're going to have some interest expense. We're also going to reduce our notes payable by debiting it. And we're also going to credit cash for some amount. So we have to figure out the interest expense. It's a $50,000 6% 6-year note. So that means it's 6% per year. So let's just calculate this off to the side. So $50,000 times 6%, 0.06. Interest is $3,000 a year. That makes interest $250 a month on a balance of $50,000. So our interest expense is $250. The amount of cash that we're going to pay is always the same, $828.64. The amount that the note is reduced by is the difference between the interest and the cash we paid. So the cash minus the interest expense. $578.64. Now we need to post $578.64 to the notes payable account. Whoops, I think we need to be able to see the decimal points on these. That's better. Okay, our next payment is due February 28th. End of the month. Again, we're going to have interest expense. We're going to have notes payable. And we're paying cash. Now we know our cash is $828.64. That's not going to change. What's going to change is the amount of interest that's charged because we have a new balance here. $50,000 minus $578.64. So our balance is $49,421.36. Now you can't They can't still charge you interest on the $50,000 because you don't owe $50,000 anymore. You only owe $49,000. So we're going to take this $49,421.36 times 6%, and we're going to take that and divide it by 12. So our interest is $247.11. Let's just drop this decimal point down one, $247.11. So we're going to put $247.11 here. And our notes payable reduction is the difference between the cash payment and the interest. So $581.53, which gets posted here. And that makes our new balance lower. So I'm not going to do that because I want you to be able to see what's happened. Our interest expense was $250 for the first month, and it was $247.11 for the second month. So you'll note that the interest is going down because the principal is going down. All right. That's installment note. The thing that you have to remember is the first month is easy. The second month you have to come up with a new balance in your notes payable. One of the most common types in big business, the most common types of long-term liability are bonds. A bond is simply a loan, but bonds are usually issued in increments so that many people can purchase the bonds. It's not like borrowing $600,000 from the bank all at once. We're issuing $600,000 worth of 7% bonds due in 10 years. So if you were to buy $50,000 worth of bonds from my company would have to pay you 7% interest over the 10 years, and at the end of 10 years, they'd have to pay you back the $50,000. And you can read in your textbook about bonds. Just as a side note, you do not have to calculate the issue price on bonds. Bonds are issued based on the market rate of interest. The market rate of interest is set by the Federal Reserve, the Fed. And the market rate of interest drives all other rates of interest across the country. It drives mortgage interest, it drives loan interest, it drives bond interest. Bonds are quoted as a percentage of face value typically in the bond news, if you're interested in that. Let's talk about how we record bonds in accounting. We first have to create an amortization schedule. So we have this bond, January 1st, 2021, they issue $600,000 worth of 7% bonds due in 10 years, with interest payable semi-annually on June 30th and December 31st of each year. The market rate of interest is 8%, so the bonds issue at a discount or below face value. This has the effect of issuing the bonds at market rate of interest. So these bonds issue at $559,229. That's market. That's based on the market rate. I'm not going to ask you to price bonds. You can find any bond calculator on the internet and you can price bonds. Let's just first do the bond issue. So the bond issue, if I issued the $600,000 worth of bonds for $559,000, what I got was cash $559,229. What I have to pay back at the end, bonds payable, is $600,000. And I seem to be having trouble with my decimal points. Sorry about that. Let me make this a little bigger too so you can actually see it. All right. So we have to pay back 600,000 at the end. 600,000. We actually got $559,229. The difference between those two is called discount on bonds payable. And we're going to debit that account. That is a contra account, contra to bonds payable. The carrying value of the bond is $559,229 on the issue date. Because we take the bonds payable on the balance sheet, we subtract the discount on bonds payable. Now, in order to do the semi-annual interest payments, we first have to run an amortization schedule. This helps a lot. If you can do the amortization schedule, you can do all the journal entries. So on 1/1/2021, the carrying value of this bond is $559,229. Okay, let me just silence my phone here. All right, so we have this carrying value. How much cash are we going to pay for interest? Well, we said back here on the face of the bond, it says we're paying 7% interest. So we have to pay 7% interest. But we pay it semi-annually. So it's half of 7%. Or the face amount times the stated rate, the face amount, 600,000 times the stated rate divided by 2. So we can actually do it that way. It's 3.5%. So 600,000 times 0.035. Oops, not divided by. So our interest that we're going to pay is $21,000. We're always going to pay $21,000 every 6 months, regardless of what the bond's issued at, what the discount is, because this is what it actually says on the bond. And if someone purchases the bond from us, they expect to get 7%. The interest expense is based on the market value, which is 8%. Okay, so half of that, because it's 6 months, is 4%. So we're going to take the carrying value times 4%. This one, you take the face amount times half the rate. For the interest expense, you take the carrying value, which is right now 559,229, times 4%. The difference between these two, and this is not a plus or minus number, it's simply the difference between the two, is $1,369. We're going to increase the carrying value by that. So we're going to take the 559,229 and we're going to add the 1,369. Now we're going to do all that over again. The cash paid for interest, $21,000, always, because we said we'd pay it. The interest expense, the carrying value, times 4%, half the market rate, because it's 6 months. The difference between the interest expense and the cash paid is $1,424. We're going to increase our carrying value by that $1,424. The goal is to get back up to a $600,000 carrying value so that at the end we can pay off the $600,000. So now that we have this table, we can do the journal entries for the interest expense. On June 30th, we have interest expense, and that would be this number, 22369. We're going to reduce our discount. So we're going to credit discount on bonds payable. And we're going to credit that for the 1369. And we're also going to credit cash for the amount of cash that we paid, which was $21,000. Now let's post this stuff so that we can see what happened. So the interest expense, debit, discount on bonds payable, credit, and of course our cash, which we forgot to post the original amount. And then we'll post this cash that we paid out. Now what happened here is we reduced the discount on bonds payable. If you remember, that's subtracted from the $600,000. So it increases the carrying value because we're reducing the amount we're subtracting. The carrying value is $560,598, which is what it is at the end of June 30th. December, we're just going to repeat interest expense. And we're going to take that from our table, interest expense. We're going to credit discount on bonds payable. And that will be this difference here, $14.24. And we're going to credit cash for the amount that we paid, $21,000. Now let's post those. So interest expense, $22,424. Discount on bonds payable, $14.24. Cash, $21. This reduced our discount on bonds payable account. If you remember right, it started out at $40,771. We're reducing it by $13.69 for the first interest payment, $14.24 for the second, and we have a balance of $39,978. If we subtract that from the $600,000, it gives us our new carrying value, which is up here. So that's how we record bonds. You'll want to make sure you know how to do this schedule, and always start with that. Okay, let's do another one. This one, it's just a bit bigger. This one, they issue $600,000 of 7% bonds due in 10 years with interest payable semi-annually. Same issue, except the market rate of interest at the time of the issue date is only 6%, not 8%. So the bonds are going to issue at a premium, more than face value. Back here, the bonds issued at less than face value, so they issued at a discount. Here, they issue at $644,632, which is more than face value, so it's going to be a premium. So let's just enter the bond issue on January 1st. So how much cash did we get? Well, we got $644,632. How much do we have to pay back at the end? We have to pay back $600,000. Okay. The difference needs to be credited. The difference between the cash we got and the amount we have to pay back at the end, $44,632. That is called a premium on bonds payable. Discount and premium. So this one's a premium. Let's go ahead and post that. So our cash, our premium, and our bonds payable. The carrying value of this bond, you'll notice, is larger than the face value because we add premium on bonds payable. The goal is to get it down to 600. Back here, the goal was to get it up to 600, the carrying value. So let's do we need to do the interest payments, but we need to do the amortization table first. So our beginning carrying value is 644, 632 because that's what we issued them for. Cash paid for interest, well, it's still 7% or 3.5% for 6 months of 600,000. So 600,000 times 3.5%, we already know that's 21,000. Interest expense is the carrying value times half the market rate because it's 6 months. The market rate is 6%, so half of that is 3%. So the carrying value times 3%. The difference between these two, again, it's not a negative or positive number, it's a difference, is 1661. What we're doing here is subtracting it from the carrying value because we want to decrease this down to 600,000. So 644, 632 minus 1661. Okay. That's our June 30th interest payment. December 31st, well, it's still 21,000. That can't change. But the interest expense is now the new carrying value times half the market rate, or 3%. And the difference between the two of these, 21,000 minus 19,289, is 1711. We want to reduce the 642,971 by the 1711. So that's our amortization table for a premium. Let's do the journal entry for the interest payments. So interest expense is going to be 19,339 for the June 30th payment. The cash is going to be 21,000 always. We're going to need to debit something for the 1661 so that our journal entry balances. This would be premium on bonds payable. Let's go ahead and post that. So interest expense 19,339, premium on bonds payable 1661, and our cash 21,000. Our carrying value over here is our bonds payable plus our premium, so our new carrying value is 642,971, and that's what it shows in the table. Because we're reducing the premium and we add the premium to it. So when we reduce it, it reduces our carrying value. The December 31st payment, interest expense, premium on bonds payable, and cash. So our interest expense, the 19,289, the premium 1711, and the cash 21,000. If we post these, interest expense, premium, and cash. You'll notice that our premium went down, so the amount we're adding goes down, so our carrying value goes down, and it matches what we said in the table, 641,260. Okay, one more example, E916. So another bond. On January 1st, this company issues 500,000 of 9% bonds due in 20 years with interest payable semi-annually. The market interest rate on the issue date is 10%, and the bonds issued at $457,102. In this one, they show you that they've already done the amortization table. So here's the issue price, right? We want to show that the bonds have a carrying value of $458,633 on December 31st, 2022. So we've done all of the math, the amount we paid, the $500,000 times 4.5%. The market rate was, on the issue date was 10%. So the interest expense was $500,000 times 5%. There was an increase in carrying value because it was issued at a discount below face value. So, assuming that the market rate drops to 7% instead of the 10% on December 31st, 2022, it will cost us $601,452 to retire the bonds. So we want to pay them off early. If we pay them off early, it depends on what the market rate is when you pay them off or retire them. So we want to record the retirement of bonds on December 31st, 2022. So we have to know the carrying value on that date. We know that we're going to debit bonds payable for $600,000 or $500,000 because we have $500,000 in there. Okay? At this point, we have to figure out how much we had in the discount account. So, what did we have in that discount account? Well, we know that our carrying value was $458. So the difference that we had in there was all of these things. Well, let's put them in separately so you can see that. I'm going to have to add a row. So 391 and 411. Okay, sorry. I didn't have it set up properly and I got lost in it because I didn't pay attention. I was too busy talking. So here's the deal. We want to retire it. The amount we owe on bonds payable is $500,000. We started out with $42,898 discount because the carrying value was $457,102 on the issue date because that's what it was issued for. Over the years, we have increased our carrying value by reducing our discount account. So 42,898 minus 355 minus 373 minus 391 minus 411. So our carrying value is now 41,306, or our discount account is now 41,367, and our carrying value is 458,633. I'm not sure you really need to know all of that, but I want you to understand how it got there and what we're doing, why we're doing what we're doing. So we have to pay $500,000 to pay off our bonds payable. We said we would. It's going to cost us $601,452. So our cash is going to be $601,452. We have to figure out what these differences are. Well, we know we need to get rid of this account. It needs to go to zero because we're retiring these bonds. To make this account go to zero, it has a debit balance of $41,367. We need to credit it $41,367. So we're going to credit discount on bonds payable. Well, we don't have any, it doesn't equal. The difference is 601 plus 41,367 minus 500,000. So the difference is 142,819. That's our loss on bonds payable. So what you need to know to do this is you need to know the balance in this account. It's really, and the price you have to pay to retire them. You can back into all the other numbers, but I wanted you to see how it worked. Okay. Well, I think that's all I have for you. Have a good week. If you have questions, as usual, post it in the discussion. I'd be happy to help.